Are you planning to, or have you already sold a property with a big capital gain? Are you not sure where you're going to reinvest this money, or you also want to save big taxes on this? If this is what you're thinking, today is going to be a treat for you. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach. I'm on that quest to help millions of people in India to never have to worry about money, and that happens when you start making better decisions with the money that you already have. And this video is one more step closer to the quest of me helping more than 1 million Indians to live a life which is completely free of money worries. So watch this one very carefully. The main big problem that we see today is that people are using traditional ways in the modern times to manage their money. The traditional ways which people used to follow through in the past when it comes to exiting from real estate was that they used to go for option number one mostly. They used to sell a residential property and reinvest the money into another residential property. The capital gain that comes from this, they don't have to pay any tax on this because it's residential to residential. Unless you're moving out from residential into others, then you have to pay taxes. So if you go for option number one, the first traditional way, you don't have to pay any taxes. And you're also planning your reinvestment. But if this is not what you're doing, you're going for second option, which is investing in 54 EC bonds because you need the money for maybe a marriage, for your children's education, or some other financial contingency that you have. In a scenario like this, the money is going to be taken out of the asset, but you still have to pay the taxes on the capital gains you've made. To save that, you will invest in 54 EC bonds. Now, the good thing about this is that whatever capital gains up to 50 lakhs that you invest in this type of bond, you don't have to pay taxes on this. The downside is the returns on these bonds are typically about 5% and they're also fully taxable. So your money gets locked in for 5 years, 50 lakhs can be invested, tax can be saved, but the gain on these bonds will be fully taxable. Again, not very lucrative, isn't it? What if I tell you there are better ways to do this? And here is what it is. So here are the modern ways of actually doing it, and that is known as by creation of a portfolio. So what does that mean? It means that you are taking out money from one asset and you're moving it into other assets by creating a digital portfolio. So what do I mean when I say digital portfolio? I'm talking about investing into financial instruments today. So when I say financial instruments, you mostly are thinking I'm talking about stocks. No. In fact, there are almost 7 even more methods through which you can do so. So here is what it is. You can invest, take out that money and invest into digital gold. This could be gold ETF or sovereign gold bonds. You could be investing into indexes or fund of funds of indexes, which are ETFs of the same. So like Sensex or Nifty and so many others there out there. You could be investing into corporate bonds, which can in these times as well make you between 8 to 12% returns. You could invest in peer-to-peer lending. You could invest in stocks, in REITs, InvITs, and other alternative methods. You can create another property-like investment which is liquid, less taxable, high return, can match your risk profile, and the best of it all, you can withdraw the money in whatever fractions whenever you like. Isn't that beautiful? Now, the only context here is the tax loss that you are going to get when you go for this option. How will you overcome that? See, the returns of these instruments typically is way higher than what the real estate markets that have offered in the last 10 years. You've already seen how the equity markets have done in the last couple of years. I want you to understand a portfolio can easily grow between 10 to 12%, something a property cannot give you an assurance of. Here, to a very high extent, you can create that assurance of return. You can have higher liquidity. You can plan for lesser taxation or no taxation on the gains of this, but you will have to pay the tax on the money that you've taken out, on the capital gain on the property. But the gains here will make up for that with the benefit of liquidity, with the benefit of fractional investment, with the benefit of a lower risk for a standard or higher return. So, and this in the overall picture also helps you to de-leverage yourself or de-invest from one asset class, which is real estate. And predominantly 80% of the people's 80% of the money is stuck in this asset, isn't it so? So it's about time to change that. So with this, I really hope that you've got a new insight about what possible actions you can take. If you'd like to know more about this, do not forget to ask the wise guy. Take care.